Hello, I'm MaryAnn. A recent headline I saw said that value investors might be better off on vacation. And with markets near all-time highs, it's not surprising that value stocks are harder to find. But are the tables now turning? I'm joined today by Anish Chopra, who is Managing Director at TD Asset Management and Portfolio Manager of the TD Canadian Value Fund. Well, Anish, what do you think? Is anything changing now? Is it still as hard to find value stocks?
Well, MaryAnn, I think the answer is it depends. So it depends on the market. So if you look at the U.S. market, you look at the S&P 500, it's up around 50% over the last 3 years. So it may be tougher to find value there. Having said that, there's been some correction in some of the more speculative areas like biotechnology. But on the other hand, when you look at the Canadian market, when you look at the TSX over the last 3 years, it's only up 10%. And in that's an area, the Canadian market, where we're finding value in both financials and energy.
So there's a little more disparity then. How do you actually drill down and find those value stocks?
We use screens, we use different valuation metrics depending on the industry in order to find the stocks, the companies that meet our criteria. And what we're looking for essentially are strong business franchises, strong balance sheets, good management teams, strong free cash flow generation, and all of that at a discount.
Okay, so is it a little bit more, is your style a little bit more relative value, would you say, than say deep value?
I would say so. I think when we look at value, we're comparing it to the company's own, when we calculate intrinsic value, so we compare it to that. We also compare it to the relative value that we're finding in the marketplace. So for example, if we buy a certain company, is it cheaper than the market? So from that point of view, we certainly look at all the different valuation measures, so whether it's discounted cash flow or relative value to the market or to the peer group.
So some value managers are sitting a lot in cash, then waiting for the next correction. You're not in that camp then, are you?
No, in the value fund we're pretty much fully invested, but I think the key when you're making that decision is it's not really just whether the market's high or not, because even if you have a high market, sometimes there's pockets of opportunity, some sectors that haven't done as well as the market. On the other hand, I think the most important thing is not to let your investment criteria and your quality levels drop because you just can't find the opportunity set. In that case, what you really want to do is sit in cash or find other areas to invest in, but you just don't want to reduce your investment criteria. You want to keep the quality level as high as you can.
And you've brought a couple of examples of value stocks that you like. Royal Bank was the first one. That's kind of surprising because you think it's a big, large cap bank. It's run up a little bit lately. Why do you find that value?
Sure. So as you mentioned, it's certainly a large company in Canada. It's the largest bank by assets, 12th largest bank in the world by market capitalization. When you look at where its earnings come from, over half come from the retail bank, 20% from the capital markets area, and the rest from wealth, insurance, and transaction processing. For us, though, when you look at the Royal Bank, here's a firm that you're getting at just over 11 times next year's earnings. Generally, banks tend to trade at 12 times, so a little bit of a discount. You're getting paid to wait in the sense that the dividend yield is 4%. And when you look at things like profitability metrics for the Royal Bank, return on equity, return on assets, they tend to be higher than their peer group. And when you look at loan quality, it's very strong. Their loan loss provisions tend to be less than the peer group. So for us, it's a combination of modest PE of 11.5 times and mid-teens return on equity.
So is this something that just happens from time to time? Different banks will be higher or lower in value relative to each other?
Oh, for sure, depending on the different strategies they pursue, investor perception of the success of those strategies. So for example, in the case of the Royal Bank, if you look at the U.S. reporting season so far, the capital markets area seems to be a little soft, but we're looking at the Royal Bank over a much longer time horizon than just the last quarter.
Okay. And your next one was Canadian Natural Resources, so the energy sector.
Right. So one thing to note about Canadian Natural is that their earnings stream tends to be a little bit more volatile because they don't have refining assets to offset the oil price volatility. But with that caveat, there's a lot to like about Canadian Natural Resources. And the main thing is the growing free cash flow profile. So management recently indicated their belief in that strong and growing free cash flow by increasing the dividend by 90% relative to the 2012 level. And when you take a step back and you look at Canadian Natural, what's happened is they've spent a lot of money getting 2 oil sands projects on stream, Horizon and Kirby. That spending is set to slow, and if you look out a number of years, free cash flow could be between $4 and $6 billion, assuming the current commodity price. Assuming the current commodity prices. And then when you look at this, you say, okay, well, interesting, growing free cash flow. How much am I paying for this? It trades at just under 5 times cash flow. The global peer group is at 6 times, so it's a discount. You get a dividend yield of 2%. Debt to cash flow is manageable at around 1 times. And the really interesting thing about Canadian Natural is 30% of their production is in natural gas. So they're a beneficiary of the recent higher natural gas prices.
So I guess more people lately have swinging more to oil than natural gas. Is that why it's undervalued, or is there a particular reason?
I would say that the Canadian energy sector generally has been undervalued, and that's relative to the global peer group. So the Canadian energy sector trades around 5 times earnings. The global peer group's at around 6 times, and that's been around for a number of years.
All right. Well, thank you very much, Anish.
Thanks for having me, MaryAnn.
I've been joined by Anish Chopra, who's Managing Director of TD Asset Management. Thanks for watching.